Joining us live on Street View at Lunch is K. Ramanathan, CIO of ING Investment Management. Ram, thanks for chatting with us on ET Now. Given the weakness that we are continuing to see on the currency, do you think we're likely to see a similar pattern as far as equities are concerned as well, and it's likely to be weak sentiment, at least in the near term?
Yeah, I agree. There seems to be no respite on the currency side. Clearly, we need capital flows, whether it's debt or equity. Valuations of securities or stocks don't matter if capital flows reverse. We've seen that during crisis period, that you can have cheap stocks, but they get cheaper if there is nobody to buy. And since a significant portion of the buying is happening or has happened mainly from the FII segment, because domestic mutual funds have actually degrown. We are not receiving any major inflows, nor has the insurance sector received any significant inflows. So the market was clearly being supported by FIIs, and we have seen significant amount of flows last year, which has perked up the markets. And if we see that reversing, you don't have any buyers here. I mean, again, we continue to bleed on the equity side in terms of marginal outflows, I would say, but no inflows at all. The insurance sector also can support to some extent. But beyond that, surely further selling pressure from the FIIs would create pressure on the markets.
Mr. Ramanathan, hi, afternoon. Just a word on what the rupee weakness may actually do for the entire OMC basket, because just today itself, as the rupee breached the 61 to the dollar mark, we've seen the OMC stocks really taking a beating.
Yeah, clearly they need to increase the diesel price and the petrol prices further, because on a rupee adjusted basis, clearly their import costs have risen significantly. Earlier, one thought by October, I mean, when we started the 50 paise hike per liter of diesel in the month of January, possibly at that time the rupee was 54. Assuming a static rupee, we should have ended that 50 paise hike somewhere in October, November, because the under recovery at that point in time was close to 6 rupees. Today, despite increase of 3.5 rupees, the under recovery remains at around 8 to 9 rupees. So you need further 1 year and 3 months of 50 paise hikes. Clearly, until then, the OMCs will suffer because they are not being compensated the market price for the produce. They have to bear significantly higher interest costs to fund the higher subsidies, and clearly that's a pressure on the profitability of the OMCs.
What about FMCG stocks, Ram? Because there is this thinking in the market that now with some amount of money getting pulled out of the HUL stock, that could in turn find its way to some of the other FMCG names, maybe some of the mid-cap FMCG names as well. Would you agree with that view?
It's a very difficult call, frankly, because if you see the mid-cap FMCG stocks have also got re-rated. Some of the mid-caps are trading at 24 to 25 times FI15. So the re-rating has already happened because that's the only safe haven. Under normal circumstances, given that there is already a worry about consumption slowdown, there should have been some amount of profit booking or some amount of de-rating of some of these stocks, but clearly that's not happened because whatever little money is there, it has to flow in somewhere, and there is no more safer place than the FMCG sector, because here, yes, your volume growth may not be 8%, it might disappoint, it might be 4%, but still you're having positive earnings growth. So the PEG ratios of some of these stocks, which used to be maybe 0.8 to 0.9, are currently about 0.5 to 0.6. So surely these are very expensive stocks today. There is certainty, at least in terms of earnings growth over the next 2 years. So clearly the reflection of valuation of the FMCG stocks indicates that we will not have any recovery in the next 2 years.
Mr. Ramanathan, what about pharma? Would names like Lupin, Dr. Reddy's continue to outperform?
Yeah, the benefit of the rupee is clearly there. There is decent amount of volume growth, exports. Some of these names have been surprising on the positive in terms of results, including margins, and clearly they are defensive. So all these, I mean, there is only benefit to them in terms of whatever is happening. I mean, money has to flow into these stocks. If you don't believe in the economic recovery, if you believe in volatility because of elections, if you are worried about currency, obviously the currency depreciation benefits these companies. If you're worried about the QE pullout, which impacts so many other things, if you're worried about interest rates not being cut, clearly this is the segment which you will be in.
Finally, a quick call on the IT pack, Ram. How do you expect earnings to be this quarter, specifically with Infosys? Do you see the possibility of the company actually cutting its guidance as well this quarter?
It is possible, at least I don't want to go into specific stocks, but clearly the new chairman has indicated that it will take 2 to 3 years' time for stability to return. So if there is an expectation of a immediate near quarter bounce back in terms of QOQ volume growth, I feel the market will be disappointed. But at the same time, one needs to see the valuation also, and there is some amount of comfort in terms of actions by the new chairman in terms of salary increase, morale boosting, etc., etc. So ultimately, unless there is significant negative impact because of the immigration bill, the outcome over the next 2 years because of the recent management change should be positive. But clearly, again, this sector is a beneficiary of currency, so this sector per se should outperform. Valuations of several stocks, except maybe the largest stock, are not very expensive, and rupee itself will give that kind of earnings growth despite salary increases. Some amount of productivity gains can also result in margin expansion. There is expectation that if US bounces back, discretionary spending also will increase. So that should again be beneficial for volume. So overall, given the outlook of US as well as what is in the emerging markets about further depreciation of emerging market currencies, this is a good sector to be in.
Ram, good chatting with you. Appreciate you taking the time out and joining us today on the show.